Good morning, everyone. Good morning, Temmie. How are you doing today?
Doing all good.
Waiting for the live stream to connect. Hold on, having an issue with Instagram. One moment while I get that.
Good morning, Maggie. Good morning, Shelly.
Apologies for the slight delay. Having a little trouble with Instagram, so resetting it. While that is gearing up, if we have any new folks on or watching on the video replay, I want to introduce myself. My name is Paul Nalabandian. I am with Fulcrum Residential, proudly affiliated with Keller Williams Capital Properties, also on the Agent Leadership Council. And Fulcrum Residential, we are powered by Place. I am your DMV real estate expert and joined as always, moderating in the chat, keeping things under control is Temmie. Wait, it's not Temmie the Great today. It's Temmie All Smiles Koji, my wonderful Fulcrum Residential colleague. Temmie, you want to introduce yourself?
I'm Temmie.
That is perfect. All right. And it looks like we are going live on Instagram right now.
Morning, Tom.
Okay, perfect. So we are about to get started. Good morning, Maggie. Good morning, Shelly. Good morning, Tom. When people pop on, if you just want to throw your name in the chat and where you are licensed to practice, or if you're not a real estate agent, if you're just a consumer or a real estate industry professional, let us know where you live, what area you're interested in. As always, I love this to be as interactive as possible. It's a little bit harder now that we're off of Zoom. We can't have live conversation, but we can have almost real-time interaction in the chat. So please drop any comments you have. I can pull all the data there is locally, nationally, wherever, but there's a granular level of boots on the ground data, what we are seeing in real time, what happened with the offer you submitted this morning, that kind of thing, that invaluable level of granular data that all of us can provide that I love to hear about. So please, let's keep this as interactive as possible. We are about to get started. First, going to go to my new tradition, coffee of the day. Coffee of the day is a Sebastian Ramirez white honey geisha from Columbia by way of JBC in Madison, Wisconsin. Delicious coffee. I had it first with the Advent coffee calendar from Onyx in December. It was so good. I had to track down some beans from another roaster. So we are about to get started. Hey, Katie, great to have you. Hi, Chiquita. Good morning. All right, let's get rolling. We are going to follow the same format we always do, the underlying information and market changes, but we try to keep our format consistent. We are going to start off with mortgage rates and economic data. We're also, I'll hit ever so briefly on why I cover the economic data. Short answer, spoiler alert, is because it is incredibly important to our business, our profession, and our clients. Then we are going to go into real estate specific data. We are going to start at the most recently reported month, which is May 2025 for the DMV region. Then we are going to take a closer look at county level data. We're going to close out the real estate data portion with the most recently reported weeks. Then we're going to talk about how the administration policies continue to affect our real estate market and go into some key takeaways. All right. The gently encouraged, aka forced audience participation. Although now that it's not real-time interaction, I'll go ahead and start to move on as people chime in the chat. But another thing I love to hear, super valuable, is we can talk about all the publicly posted rates, what Freddie Mac is reporting, what Mortgage News Daily is reporting. But it's also wonderful to hear what our clients are locking in at in real time. So if anyone has clients who have locked within the past few days, within the last week, I'd love to see those numbers in the chat. And if you do that, please mention whether it's fee simple or condo, and if it happens to be an ARM or VA, FHA, anything like that, would love to hear that as well. So mortgage rates, as you can see here in the chart reflecting the last year, been a lot of volatility. I've been predicting that for quite a while. We've been talking about that for quite a while. Nothing surprising here. We have seen a little bit of a respite since last month. Mortgage rates, you can see here on the right side, have been coming down, a little bit of a rocky path, but all of these numbers are about 10 to 20 bips lower than they were when we met last month. So this is, I always talk, the numbers on here are for Mortgage News Daily, and they use their metrics. This isn't necessarily what your clients will get in the real world. If your clients are very well qualified with fee simple, there are real world products coming in lower than these numbers. If there's some issues in the finances, these numbers could very well be higher. Same thing with condos. Those rates tend to run up just a little bit. 637. Nice. Thank you, Shelly. Yes, some pretty good rates out there right now for VA and FHA, at least compared to where we have been. We're going to keep moving on, but love to hear more rates, more real world rates that clients are locking at right now.
6.7 conventional for one of my clients.
Nice. And where would you say they fell as far as like in the range of the rate they could expect to get? Kind of middle of the pack, like everything perfect, some
I think middle, and this was the, we locked in beginning of June.
Okay.
I also got quoted 5.8 ARM, 7-year ARM. Since 08, like I've never even thought or considered an ARM product for any of my clients. Like I haven't even had a client that has like chosen an ARM product, but now it's seriously being looked at as an option, especially if we're thinking that rates may go down, next few years. Yeah,
I'm glad you mentioned that. We've touched on that kind of briefly in spots here, but same goes for me. Since rates started creeping up, surprisingly, there were very, very few, well, none that I had seen, any decent ARM products. That's starting to change. So for agents out there who have clients, shop around to some ARM products, reach out to your lender partners, see what they have available, because there are some very good ARM rates that I've seen, including multiples in the fives. These are real world rates that people are locking at as far as numbers in the ARM. And so that makes sense. Everyone is expecting mortgage rates to drop sometime within the next 5 years. We're expecting them to come down sooner than that, although that date keeps pushing off. So yeah, ARM is a great product right now. 6.5 conventional with Envoy, 20% down, great credit. Thank you, Tom. Yeah, none of those numbers are shocking. That's kind of what I'm seeing, what is happening in the real world relative to the numbers that are being reported. So how are people feeling about the economy? Also, please feel free to mention, just drop in the chat. How are you feeling? How are your clients feeling? I can tell you what is being reported, what I'm feeling, and what my clients are feeling is that it's a little bit all over the place. There are two major surveys of consumer sentiment. One is done by my alma mater, the University of Michigan, and they reported an increase in consumer confidence in this last reporting cycle. Another major survey that's relied upon by economists reported consumers being more pessimistic about the economy, more worried about how things are going from May into June. And that reflects how I feel, what I'm seeing. Some people feel that a little bit of the recent uncertainty has leveled out. Life is maybe a little more predictable. They're not quite as nervous. Others seeing the potential of global conflict, still rising tariffs, all of this stuff are a little bit more concerned. And so for us in our business, it's just important to stay in touch with what people are feeling, what your clients are feeling, because it's important to be able to provide advice and counsel related to that. There's a lot of speculation out there. It's important that we provide actual facts and actual data. That's one of the reasons why Temi and I are here every month providing this information for you. So going into ever so briefly why I touch on the economy, we are going to skip ahead of this, but when you get in the deck, you can take a closer look. It's essentially, we pay attention to the economy because everything that goes into the economy affects the bond market. Bond markets affect mortgage rates. Most mortgages are repackaged into mortgage-backed securities. Those compete with other instruments, other investment instruments out there, mostly other bonds, similar debt type instruments. And as the bond market goes, that's where mortgage rates goes. That's where mortgage rates go. And if you understand what's happening in the economy, if you know what's happening in the bond market, then you'll know what is happening and what is going to happen with mortgage rates. Fortunately, a lot of these early factors here, particularly tariffs, trade policy, and economic wildcards. I could also add global military conflict. Those levers have an outsized impact in what is going to happen and are a little bit more unpredictable. And that's why we're seeing more volatility now. Jumping into the economy, since we last met, the second estimate was released for GDP of Q1 2025, and that just dropped down a little bit. It had been reported at negative 0.3% contraction of the economy. Now that is down to negative 0.2. The estimate for Q2, and this, just keep in mind, this is where things are headed. All things being equal, a slower economy should lead to lower mortgage rates. There's some other factors coming into play here, which we'll talk about, but that's why we are covering this stuff. Right now, the GDP Now model out of the Federal Reserve in Atlanta is estimating a Q2 GDP of 3.4. Obviously, that would be a lot higher than the contraction of 0.2% we saw. But just keep in mind, this Atlanta GDP Now model is lower than most other reputable models, and you can see that here in the spread. This is the range. The blue swath is the range of the top 10 and top bottom average forecasts. You can see that Atlanta GDP Now model is at the very, very top of that. So blue chip forecasts are coming in anywhere from basically no growth up to the 3-4, and average tends to be around 2% coming in. Now we are going to pop into inflation, consumer price index for the month-over-month change, which was reported as a 0.1% increase, and then also the all items for 12-month, which was 2.4%. I've mentioned this last month, and I think the month before, that you had to take this with a grain of salt because the impact of tariffs can be so massive that this information is dated. And not only is it dated, but these levers of tariffs and how they can impact prices are so big that it kind of dwarfs everything else. And that's still the case because that hasn't all played out, and most people feel that these prices haven't yet been realized. And this is something the Fed is watching as well. These higher prices, how much of them will be absorbed by companies crunching profit margins, and how much of it will be passed on to consumers? And we're going to talk more about these crunching profit margins just a second when we get to jobs. But now you have to add another caveat to this information. And it is that there are, I don't know if any of you are noticing, but I'm noticing everywhere effects of federal government cuts. A ridiculous example, there is, when I'm cycling around the mall, there are bathrooms just off the base of the Washington Monument that are a great place to stop. I can put my bike right outside, don't have to worry about it getting stolen, can pop in and out really quick. I've been using this restroom for the past 20 years. And the last time I went in there, it was disgusting. It was absolutely, I mean, it was the dirtiest I had seen it in 20 years. And you might think this is a silly example, but it's just like, this is what is happening. These cuts, these reductions in staffing is having a rippling effect through all of government. And I mention it here because it is having a concrete effect in the validity of this data. So yeah, these numbers are pretty decent. 1/10 of a percent increase month to month, 2.4 for the all items. But it is, a lot of economists are worried about the validity of this because what typically happens in order to come up with these numbers, it's a very involved process. You have, they call them enumerators. They're the government employees that go out, they physically go out into stores throughout the country and check prices on specific items. And there are hundreds of these people going out checking, I don't even know how many prices. They get all of this data, they report back, and then experts and statisticians come up with how these prices are going into the aggregate, affecting overall, and we get these numbers. Now, when they're not able to get a specific price on a specific item, they do what's called different cell imputation. They find a similar product or the same product in a different region, and they log that. So it's essentially educated guesswork. In a given month, and I don't want to get too far into the weeds in this, but in a given month, 10% or less of these prices, these real world prices they're trying to get, are these guesses. This past month, roughly 30% of these prices were guesses. And that's more than twice as many as any time in the past 5 years. And the highest numbers prior to this past month were during the height of the pandemic lockdown. So like I said, TLDR here, just a third of the prices going into the CPI for these numbers are educated guesses. So there's just a lot more uncertainty, and there's a lot more questions from everyone, not just me. Like, major economists are questioning the validity of this data. So like I said, take it all with a grain of salt there. And what it really means is we don't really have a true feel for inflation, or at least as accurate of a feel as we normally do. And that just means, in all likelihood, it means prices may be a little bit higher than are being reported. Going into jobs, 139,000 jobs reported in this past month. That was above consensus. Survey results were about 122,000 would be added, a little bit higher than that. But it's not all rosy on the job employment front. 4.2, the unemployment rate is 4.2. It's been hovering between 4 and 4.2 for many months now. But some things to keep in mind. So a couple of indicators that we have seen. So there's been a decline in temp worker hiring, and there's certain things, the leading edge of things you can see if you're really paying close attention, which might have a greater impact going forward. So the first thing, easiest thing for employers to do, is to pull back on temp hiring. We saw that in May. There was a reduction in temp hiring. Then the other thing is there was a contraction of the labor force participation rate. This is the percentage of people out there who are either working or actively looking for a job. This number shrunk, which means some people are just like, hey, don't want a job, don't have a job, not looking for a job. This was maybe like 650,000 people who just pulled themselves out of the workforce. So there were actually a lot fewer jobs reported in the most recent month, but because a bunch of people had just stopped looking, this number wasn't affected. If that number had been incorporated, we would have seen a rise in unemployment. So the numbers are about the same. Numbers are semi-positive, but there is a lot of underlying information that the job market is softening. Why that's important, going into the Federal Reserve. So audience participation. Where does the Fed think the economy is headed? What happened? When did the Fed last meet? What is going on that front? Temi, since I miss the interaction of days past, so when we're not getting input in the comments, I have to rely on you. Any thoughts on those economic numbers? Are you seeing anything among your clients, people losing their jobs, concerned about their jobs, worried about the economy? all of that affecting their real estate decisions, anything like that?
Yeah, I am seeing, obviously job losses. I'll be doing my first short sale that I've in a while. And I honestly didn't think it would be a short sale, but, most likely it will be a short sale. And so it's definitely a change in the market. I think, yeah, it's definitely a change in the market. Tom says last week likely drop next meeting. What did Tom say? Sorry.
Yep. He's talking about the Federal Reserve. They met last week.
Okay.
The most recent meeting was last week, June 17th and 18th. They will meet next July 29th and 30th. Excuse me. And there are a lot of people who are thinking there will be a rate cut at the next meeting.
Hopefully.
There was no change in the rate as expected at this meeting. But there was more disagreement among these Fed officials for the rest of the year. So they polled them. 10 officials projected at least 2 rate cuts. And if that happens, one will likely, probably, maybe be at the next meeting. 2 officials said there would be 1 cut. 7 of the officials, so almost half, said there would be no cuts this year. Everyone has been expecting 2 cuts at some point before 2025 is over. Now there is a lot more uncertainty with that. And the Fed is basically, they're a wait and see approach. And Chairman Powell has said this. Chairman Powell just recently told Congress that the economic data out so far would have justified them continuing to lower rates, if not for the specter of tariffs. And the Federal Reserve, along with everyone else who's paying close attention, believes that tariffs will result in upward pricing pressure. Now, let's go back to jobs really quick. And we're going to get to real estate data in just a second. But this is all super, super important in understanding what's happening and what's going to happen with mortgage rates. So we talked about jobs and how there cracks are showing in the job market. Softening is showing in the job market. And you look at these tariffs. So all manufacturers are paying, and providers of goods in the U.S. are going to be paying more for various items along their manufacturing and distribution process. And there are 2 things really that can happen there. Well, so 3 things. They can negotiate for lower prices to try to eke out a little bit of the spread there. They can absorb some of these increased costs and cut into their profits, or they can pass these costs along to consumers. And probably there's going to be some combination of all 3 happening a lot of the time, and it varies in any individual circumstance. But the reason this is important is if companies are crunching their profit margin, like, where is the relief going to come from? And one of the levers the relief is going to come from is laying off non-essential workers or not filling positions that are open. And this goes straight into the job market. And the reason I share all of this is right now what the Federal Reserve is looking at prices and they're looking at jobs. And they're really concerned about both of these things. If prices start to shoot up and the job market is stable, there will not be a rate cut anytime soon. If prices remain stable and the job market is softening, then the Fed will drop rates. But it's really anybody's guess where this is going to fall out. So if you only have one takeaway from what we're talking about in this economy section, just pay attention to inflation, pay attention to jobs, and that is going to give you a big insight into where the economy is headed and where mortgage rates are. Popping ahead, 10-year Treasury, 4.3 as of when I pulled it 2 days ago. Let's take a look at the up to date. 4.272. Yeah, not surprising. We've seen mortgage rates come down by about the same rate, competing for similar investors. They're generally in lockstep with a spread because the 10-year Treasury is a little bit more of a secure investment than mortgage-backed securities, or at least it has been up to this point in the history of our government. Okay. Touching on the last few segments of the economy before we get to real estate specific data. Retail sales were down 0.9% in April. This was worse than general expectations of 0.6% of a decline, but it makes sense. Like if you're paying attention to this stuff, most of it makes sense. And one of the big drivers in this decline was a drop in auto sales. Well, if you remember, we talked about last month, there was a big spike in auto sales of people expecting prices to rise and wanting to go out and purchase those cars before the sticker shock hit. And so you had an unnatural, you had a speeding up of the process of people purchasing cars last month. And then you had kind of a natural decline also as some of those price increases started to be absorbed. Manufacturing, just touch on it briefly. Industrial production, think everything, tangible, intangible, goods and services, fell 0.2%. Manufacturing output, just the subset of industrial production that's tangible goods, that rose by 0.1%. And that was driven by an increase in motor vehicles and parts. Now we're going to cruise into the DMV real estate market. And this is where, in particular, I would love to hear people mention in the comments, and I'll try to be nice about it. I'll try to be nice about it because I really do love the information when I'm just talking with other agents in the area and hear what they have to say about the market. A lot of it is inaccurate. I mean, this is why I started doing this. In talking to my clients, but also talking to other real estate agents and top agents, they would say things about the market that weren't true. And they might have been true for what they were seeing through the prism of their own eyes and their day-to-day business, which was generally like a certain subset, whether it be price-wise, location-wise, property type, condo, fee simple, whatever. But what they would be seeing in just a small little microcosm of the market wasn't really what was happening in the market as a whole. So, but I would love to hear that. I would love to hear what people are seeing, because it really is, unless you're taking this holistic view and seeing things from the 30,000 foot, 10,000 foot view, whatever, it's easy to draw different conclusions about what's going on in the market. And I know because it happens to me where I'll feel like, oh, wow, this demand is really drying up. Like demand is a lot softer. Inventory is incredibly higher. And I look at what's actually happening, and it's either maybe not happening or not to that degree. And that's what we're seeing. And I'm going to touch on in more detail, is that I hear so much about it being a buyer's market and so much about just flooding inventory. And that's not the case. It is, we're seeing more inventory than we have seen, and we're seeing softer demand relative to supply, but still seller's market in much of the area. What are people seeing out there, though? Homes are sitting on the market longer?
Yeah. Sorry, I've also been just in talking and masterminding with other realtors. One of the biggest things that I'm seeing is that it seems we're getting a lot more sellers that still want the higher prices, and it's really important to have the conversation of like price expectations, because it's not that it's a bad market or down market. It's just not the same market as it was a few years ago. So it's still a good market. We're just not going to get 15 offers, and pricing the home right is incredibly important. Because buyers kind of feel like they either have options. Sometimes realtors aren't aggressive to even try to price to even try to put in an offer on a home, that they may feel like is higher priced. So pricing a home correctly in the beginning is so important. But I'm hearing a lot from realtors with that, the demand from seller clients is to, list at a higher price, but the market is not supporting, higher than normal prices. Yeah.
Mm-hmm. Absolutely. And it's never a good idea to price too high. And it's never a good idea, regardless of how hot the market is. There's no surer way to get a poorer result than to overprice a listing. But when demand is softer, that's a greater recipe for disaster. And that's what what you said pretty much reflects this, in that hold on, I'm just pulling up. I want to see a quick example from my business recently. But what we're seeing is that it's with demand a little softer relative to supply, sellers can't just dictate all terms like they have done in the past, but they're still getting good results. So recently I listed actually closed this month on a townhome in Potomac Yard, beautiful townhome. And these are generally in high demand. We went under contract We hit the market on a Thursday, went under contract on a Tuesday for list price. And I was talking to some agents, and an agent who does a lot of business in the area. She was like, wow, it's just buyer demand is evaporated. And it's just crazy out there. It's crickets. And it's like, okay, yeah, the buyer on my listing had a home inspection contingency and we only had one offer instead of multiples, but we were still under contract in 4 to 5 days at list price. And there were a couple of other units that a couple of other townhomes in that area, and a lot of them had gone under contract within a week. And the one before me had taken 2 weeks to go under contract. And then the one after me took, I think it was 50 days to go under contract. So a month and a half. But it's like, that's still not a buyer's market. It's just a little bit of a softer market. All right. So go ahead.
Sorry. Christina said something. She said, seeing a lot of price reductions, and I will concur with her. I am seeing more emails now with agents reducing prices. Before, it was, a lot of emails about, open house, things like that, or new listing, from different agents. Now, just a ton more price reduction emails. So I concur with Christina.
Well, in that, and I agree with you, Tammy. I'm seeing the same thing. I'm getting a lot more communication about price adjustments, but the question is, like, is that reflecting more price adjustments, or is that just reflecting more communication about price adjustments? And I know for me, what I'm seeing is some agents, let's say it's a minority of agents in past markets, with a listing, they'd throw it on and be like, it's going to sell. And if it didn't, they just kind of wait and they tell their sellers to hold tight. Someone will come. And there wasn't necessarily as much proactive work being put forward. Of course, everyone in this meeting, all of us here, and all of us at our brokerage, and we're always proactively doing everything we can to get the best price for our clients and our listings, regardless of market. But I think my personal feeling here is that agents are just being more proactive. They're a little bit more worried. Their clients are a little bit more worried. And so they're doing more to try to get listings sold. And their clients are more receptive to price drops. But when you look at the data, as far as percentage of listings with price drops, there's not a meaningful difference of where it has been in the past. And we'll look at that when we drop into the county data.
It's good to know.
Popping on here just to take a look at where the market is at. Right now, we're on track for a little under 49,000 units, right in the same range. You can see the right side here, the last couple of years, we're on track for a very similar year as we've had the past 2 years. One thing interesting to note, we were on pace for more than 50,000 transactions. That's dropped off slowly. I think that is going to rebound, and I'll discuss why when we get into the numbers. This goes back to, and I'm like, sometimes I get a little agitated about this, but it's just, I care and it's interesting. And I'm like, no, I want to get the information out there. I want to correct these misperceptions. So just a couple of things to note here. If you are a buyer who's been waiting for prices to come down, or if you have clients who are buyers who have been waiting for prices to come down, just take a quick look at this chart. Yes, this is DMV wide. This is not true for every area. We've been seeing softer prices in DC and some other pockets. But this is, as a whole, every single month for the last 24 months, we have seen year-over-year price appreciation. I don't know how to say it any more clearly. Blue above the line means prices are going up. Blue below the line means prices are going down. We have not seen a DMV-wide drop in median sales price year-over-year since May of 2023. I mean, we just haven't. And it's been appreciation every single month since then. And this past month, it was a little over 3% over where it was May. And median days on market are 8 days. Now, we're going to see that creep up. That is creeping up with the data that's being reported in June. As to be expected, we're seeing days on market creep up. But it's like, you have 2 years straight of DMV-wide price appreciation and half of all homes going under contract in a week or less. Like, buyer's market? No, it's not.
I love this, Paul. I feel like, this is a good example of like what we feel is noise facts.
Mhm.
We may have something that happens with one or two clients, but again, what we feel isn't always facts. Sometimes I'm looking at one client or one thing, and I'm just like, "Oh, this is the market," and forgetting about the fact that majority of like my listings literally like go under contract within a week, and the stats support that. Now, if it's a different style, like condos in DC are different from homes are not condos, right? Know that market, but this is just a good reminder that what we feel isn't always facts, and that we may have one or two instances of something, but that is not the data for all.
Mhm. Absolutely. Absolutely. And I'm glad you shared that. Excuse me. And I also want to share, like, it's understandable because it happens to me too. Even though I'm looking at this stuff all the time, I'll have some things happen with a certain client or in a particular situation, or when it's like, oh, my showing level is down, so I'm a little worried. Like, am I going to get an offer on a listing within a time frame that my clients expect, whether that's realistic or not? And then I start like, oh, the bottom's falling out. Where are all the buyers? And then an offer comes in, and it happens to me repeatedly where I'll feel like the market is different than what all of the numbers are showing. So it's perfectly natural. It's also, trying to think of a good example of this. Like, if you're somewhere where it hasn't rained for 30 days and then you get a thunderstorm come in, it's going to feel different than if you're in a rainforest where it's just coming every day. And I think and we've talked about this before, but I think that's what's happening, is that we've been in such an extreme seller's market for so long. We've had such a lack of meaningful inventory for so long that just a little bit of inventory, like just creeping ever so closely to a market at equilibrium, feels like a massive shift. It feels like a buyer's market. It feels like, there's so much supply, there's so little demand, when it isn't actually there. Okay, now hopping over to closed sales and pendings. And so this is interesting, and this is something like I want to hit on, and I'm going to hit on when we look at the weekly data as well. You can see that the closed sales for May were down 6.5% year over year. The pendings were up 3.5% year over year. And this track, so closed sales for May were down 6.5% year over year. The pendings for April were down in the 6-ish range. I think 6.5% as well, maybe down 6%, just off the top of my head, but it was right in that range. I think all of that can be explained from the uncertainty that was happening with the new administration policies. If you remember, I think it was Liberation Day when all the tariffs were announced. That was April 2nd. And there was just so much uncertainty. Like, what is this going to mean? What is going on? Are all of the federal government workers going to be fired? And we saw a lot of buyers who can make a decision instantly. Like, you can have 5 showings scheduled with a buyer later this afternoon. They can get worried about where the economy is at, where their job is at. They can cancel those showings and then sit on the sideline. So buyers can make decisions instantly. And what I think happened, and all the data I can find supports it, but I don't have surveys to back this up, is like a lot of buyers just got scared of all of the uncertainty, and they took a step back in April. I mean, we know they took a step back. It's just the question is why. I think that is why. But then you can see, as we transition into this new normal, or it seems like things have stabilized, at least in some aspects of the economy, just a bit, that buyers are jumping back in. And we see this in the new pendings. So for May, new pendings were up 3.5%. And when we look at the weekly data, we'll see that the pendings are up as well. So barring some more uncertainty, barring overseas conflicts that grow in nature and that can have a lot of cascading effects on the economy and what is going on domestically, like barring some more unexpected things, or just like, it seems like tariffs are going in a more reasonable direction. If that reverses course, who knows? Like, there could still be a lot of volatility. But if things continue as they are, I expect these numbers to continue and for us to see a little bit of a rebound in buyer appetite and activity for the remainder of the year. All right, new listings. And this is again, people talking about, oh, listings are flooding the market. There's just so many new homes coming on, and we're here in this buyer's market with a flood of inventory. So new listings for May were pretty much even with new listings for last May. So I think that kind of speaks for itself. And you can see here that the orange line is this year, blue line was last year, the gray is the preceding 3 years. And you can see we are right at where, even with last year, and we're right at the low end of where we've been at for new listings for the past 5 years. Okay, now closer look at this in active listings. And these levels, so we have seen an increase. We saw this last month. Last month, active listings were up by about 50%. We're up not by quite as much, 41.6% for May. But that still is, like I said, we're at the low end. You can see here, we are still not at 2019 levels. 2019 is kind of a baseline. I've talked about this a lot. You had the pandemic coming in 2020. First, that constricted the market, and then there was a boom in the market with the Federal Reserve's quantitative easing and mortgage rates dropping extremely low. You had a lot of buyers flood in. So we've just had unusual markets, and then mortgage rates went up. So we've had unusual markets pretty much since 2020. If you want a baseline, go back to 2019. Compared to 2019, we're still only at 80% of the inventory levels. But it is important to note, depending on where your markets are, where your buyers are, where your sellers are, that we do have some areas in the DMV that are higher inventory levels. And you can see here in Northern Virginia, you have Alexandria and Virginia right now with higher inventory than they were at in 2020. But keep in mind, that's still more inventory than almost no inventory. And I've joked before that, 100% increase in zero is still zero. So like 166% increase over a minuscule amount is still a fairly low amount. But it's important to know, and particularly, like I said, going back to these changing perceptions, if you have a seller who was used to a market where there was just zero, 0.8 of a month of inventory, and now you're at 2 months of inventory, it will feel a lot different, and it will feel like demand is softening even when it's still incredibly high. Love to hear thoughts or comments or questions about that. And I'm going to talk, I'm right now in particular, I'm not hitting on months of inventory because I want to wait until we get into the county specific data because that's more relevant. Yeah, and I think, Christina, if you want to drop after that, geographically, like where are you talking about specifically? Because that is the case, and I'll touch on when we get into months of inventory, that is much more the case in DC, and then also the case in parts of Prince George's County more so than some other areas.
Yeah, sorry, Paul. I think I'm seeing the same thing Christina's seeing, like in parts of Prince George's County, it's like buyers want more of what they want, right? Like the rule has kind of still been the same. Like you typically get around 80 to 90% of what you want in a home. You don't always. Most people don't get 100%, and now it just seems like people want closer to that 100% mark, or they feel like they can get it if they just wait, and then kind of have to see a few homes and just realize like, you really still only get about that 80, 90%, and then you have to pounce.
Mm-hmm. Yeah, definitely.
All right. In the areas that are where homes are still going quickly, like, in the areas of Maryland, like Montgomery County, some parts of Howard, like where we see like a home hit the market on Thursday, we know it's going to be gone on Monday or Tuesday. Like the buyers don't have that level of, flexibility. They have to make sharper, faster decisions. So it is location based.
Mm-hmm. Yeah. And even when the market was super hot, there was still variance depending on location. Now it's just a little more pronounced. All right, we are going to dive a little deeper into the county specific data. We're going to hit closed sales, median sales price, median days on market, months of supply. Excuse me. New pendings, new listings, active listings, and showing level. And this is a lot of interesting information here. So looking at closed sales, and we saw here that overall closed sales were down. I already talked about why I think that is. So they were down pretty much everywhere almost even in Frederick, and up more than 5% in Loudoun. Noticeable drops, though, in closed sales for Montgomery County, Prince George's County, in DC. But if you look at median sales price, it's still, so we had Frederick dropped a little, median sales price came down in Frederick, but even DC, where we've been seeing softer prices and softer demand, median sales price was up. And like, other than Frederick, it was up or even everywhere. So even when we saw an area with a contraction, a little bit of a contraction in buyer demand, there's still such little supply generally that we're seeing upward pricing pressure. And this is the median days on market. And this goes back to demand relative to supply. So you can see every single area in core DC reported an increase in days on market in May, over May of the prior year. So everywhere, overall, homes are taking longer to sell. But outside of DC and Prince George's County, they're still selling incredibly quickly. So everywhere outside of Prince George's County and DC, median days on market are 6 to 8. So that means half of homes are going under contract in a week or less. That is fast, not a buyer's market. DC, as has been the case for quite a while, leads the pack in days on market. They're at 22, and there's a fair jump over where they were at.
Is it because you think it's because of the condo market
in DC? No, the whole DC market is slower than kind of corresponding markets elsewhere. And I mean, in my opinion, I've seen population data, but it was prior to 2020, the population of DC had been increasing every year for the past 20 years. In 2020, DC lost population. DC might be back up to their 2020 population, but it was essentially just, you had a reversal of the demand calculus. And it used to be DC was the hottest, or one of the hottest markets in the DMV. A lot of people had to work here. They didn't want to commute. They had to be closer in. You still have a lot of work from home jobs. And that just changed the calculus. People didn't have to be here anymore. And so we saw a more vibrance in the surrounding markets and a decline in the DC markets. But there's something interesting to see here. And so I'm curious. I don't know. I know people I'm talking to, clients I have. I'm going out later today with some clients. I helped them sell a condo in DC a few years back. They moved to Maine because they could work remotely. Now they have to physically be back in the office. They've moved back to the area, and I'm helping them buy a home in DC. And so I am seeing this on a personal level, but I don't want to rely on that to make assumptions about the market. But this data would seem to indicate, is this related, is what we're seeing here in the market activity related to increasing back to work mandates? That's an explanation. I don't know if it's the explanation, but if you look at it, the core closer in areas have the increases in new pendings. I mean, right here, it's only the farther out areas or counties with some farther out areas. So Prince George's County, massive county. And so obviously you have parts of Prince George's County that are very close into the district, but you also have a large section of the county that's farther away. So here it seems pretty clear. Buyer activity year over year increased in the areas closer to the district and decreased in areas farther out. So
I've known several people that have moved from Prince George's to Frederick to have more space, more land, because they could work anywhere. And now there's a federal mandate to be back at work. That's a huge commute.
Yeah, no, that is no joke. I have some family out there, and visiting is not fun. But I mean, it's so much fun, but the drive's not fun. Okay, new listings. So new listings are a bit all over the place. You can see that overall for the metro level, basically no change. And same for Fairfax, same for Prince George's County. So a decrease in new listings in DC, a big decrease in Frederick, a pretty sizable bump in Alexandria, and decent bump in Loudoun and Montgomery County. So honestly, for this, I don't know. I don't have a good explanation for what's going on here, other than it's. I talked about before how it's like buyer activities. They can stop on a dime and change their course of action in either way. Like they can stop, start, and that can be happening incredibly quickly. Whereas sellers, usually the decision is made at some point in advance, and then they lock in. So just important to note. I know this is probably obvious to most of you already, but listing data is always going to have a little bit of a lag as far as new listings because people have to make decisions a little bit earlier. But as far as what could explain these varying levels, I don't know. That's a little trickier. Excuse me. So one thing though, you saw new listings varied. One thing that didn't is active listings. So there is an increase in inventory everywhere, and it's just to varying degrees. Everywhere it has at least 20% more inventory than they did last May. Some are a lot more. So Loudoun is up more than 50%. Montgomery County is up by 70%. And Alexandria almost double the inventory of last year. But remember, sounding like a broken record here, yeah, Alexandria almost double of the inventory of last year. But last year at this time, I think they had something like a month of inventory, which is nothing. And I wanted to dig a little bit deeper into this because when I talk about this, a lot of times I'll have people say, oh, yeah, you're just talking about DMV wide data. But then we'll go into, wanted to touch on when we get to months of supply. So people will be like, oh, yeah, you're talking about DMV wide data, but in my particular market or my particular area or my particular price point, that's not what's happening. And what I'm talking about is happening in most of the area and most of the price points other than DC. And so I wanted to take a closer look. You can see here that the only segments of the market, the only major geographic areas, if you look at all what's going on in the real estate market, condo, detached homes, and townhomes, the only segment with more than 2.5 months of inventory is DC. And that's been the case for a while. We know that. But I wanted to dig deeper and see, and I already have a feel for a lot of this stuff, but I wanted to pull up the most recently reported numbers. I wanted to see, well, is there some softening within certain segments of these markets? So I looked at, in all of these areas, I looked at condos, looked at townhomes, and looked at detached homes. And spoiler alert, outside of DC, there are only 3 segments of any market in this group with inventory more than 2.5 months. Only 3 in any segment. And so that's Arlington detached homes at 2.95 months of inventory. But keep in mind, in Arlington, the only price segment that has more than 2.5 months of inventory is homes above 2.5 million. And so I think that detached home inventory at 2.95 months is skewed by that higher price point above 2.5 million. So the second segment is Montgomery County condos at 2.63 months, still seller's market, incredibly low inventory. And then Prince George's condos at 3.26 months of inventory. So all property types throughout all core DMV, still incredibly low inventory, strong seller's market, other than DC. So, of course, we know DC, you can see the numbers here. It's almost 6 months of inventory overall. If you're curious, if you want to break that down, so DC fee simple is about 5 months. And so that's for detached and row homes, have about a little under 5 months of inventory for both of those. Condos, a little over 7 months. And I've said this before, like the condo market in DC overall, it is a buyer's market. It is a buyer's market, but good stuff is still selling within a decent time frame. So I want to just touch on one more thing before I end this rampage, just going about how there's misperceptions out there of what is happening. And sometimes these misperceptions get reported by reliable sources. And so I don't know if any of you noticed, Bright published something, I think it was 2 days ago, and they talked about Doge's impacts on the real estate market. And they reported like the reasons people are selling, and that's relatively insightful, and I recommend everybody take a look. But one of the things they said is more than a third of agents and brokers in the Washington, D.C. region, and I'm quoting, say that the federal workforce layoffs and cuts are causing home prices in their local markets to fall. So they're reporting that more than a third of agents are saying that federal workforce layoffs and cuts are causing home prices in their local markets to fall. Where are these markets? Like, where are these markets? This is like the only area in core DMV to have a year-over-year price drop in May was Frederick. Is Frederick the hotbed of federal government employees? I mean, Temi, I know you said there did a fair amount go there, but seriously, like, is it, there are so many federal government employees in Frederick that's the reason for this price drop? And so its perception doesn't match reality. A third of agents are saying what's happening with federal workers is causing price drops in their area. And the data is not supporting that. Like it's not supporting the fact that anything is resulting in massive price drops overall. So just it's like, but still, if you had just read that Bright article, you would think like, oh my gosh, wow, this is like buyer's market, the sky is falling. Okay, pumping ahead. And here we see here. So this is the most recently reported week ending June 22nd for the DMV. And I included this just straight from Bright. So you can see this is the area that is encompassed by these numbers. And it's what we saw in May transitioning. Like I said, so April, a lot of buyers were like, whoa, what's happening? Not quite sure. Maybe we should pause. Pendings dropped in April, caused closings to drop in May. But then we saw pendings increase in May, and we're seeing that into June. You can see that for the most recently reported week, pendings were up 3.3% compared to a year ago, and showings were up as well. You can also see that median list price is up. Now, they don't report median sales price on a weekly basis, but median list price is up. And then percentage of listings with a price decrease, less than 1%. So less than DMV wide, less than 1% more listings have a price decrease than last year. And so, Temi, this goes back to what I was saying before. That's not a big difference. Like, that's just not, that difference doesn't explain what people are talking about. And so it's that perception of what's happening and the feeling of price drops is so much greater than the actual number of price drops. And so here, this is kind of more granular. I'm not going to run through all of these. When you get the deck, take a look, like wherever you focus your practice in, take a closer look at what's happening. These are the past 2 reported weeks. And one thing that's interesting is, so I want to note that the greater DMV numbers you see in these 2 slides won't match up with this number. And that's because the greater DC region, they include a lot more counties in these numbers than they do the other ones. So it's just to note, if you notice, you're like, wait a minute, these things aren't adding up. It's because this number includes a much more of the region. But so new listings, as you can see, they're DC wide. So there was a bump earlier in the month, but then this most recently reported week, they were pretty much even. Median list price, it's kind of the same thing we had been seeing. Like I said, we don't, in the weekly data, we don't get close price. We can only look at list price. But Temi, again, like going back to what people are saying is, oh, prices are dropping and listings are shedding their price. So if we look here at the past 2 weeks, you can see 2 weeks ago for the DC region, median list price was up 7%. And the percentage of active properties with a price drop increase over the same time last year was less than a percentage. So prices are going up, and there's not a corresponding increase in properties with a price drop. Same thing here, but you can see there's a 5.4% increase in median list price and 0.5% increase in properties with a price drop. So we're just not seeing this flood of price drops. New pendings, if you go down, you can see basically even down in Alexandria, even in Prince William, up in Prince George's County, and new pendings were up double digits everywhere. So this is continuing into June. What I said we saw happen: buyers putting on the brakes in April, coming back into the market in May, and we're seeing that coming into June. We're seeing a more vibrant June market than we saw last year. So basically, over the past 2 weeks, median list price is up, new pendings are up, showing level is up. All signals this is a more vibrant market with increasing demand, albeit slightly. Not these aren't massive changes, but we're just seeing a continued, like this path that started in May as buyers got a little bit more comfortable of the new normal current reality that they're entering back in, and we're just seeing a gradual uptick.
Paul, I'd love to quickly hear from like some of the agents on this call. Like, what are your thoughts on this? How you're feeling versus the stats that are out there? Like, what are your thoughts? Are you feeling a little bit more settled now, like the sky's not falling, or are you like still kind of like, no, that's not what I'm seeing? Like, what are your thoughts? I'd love to kind of get to know what's kind of running through your heads right now.
Yeah, absolutely. I would too. And I'm gonna continue on just to hit this because we're 1 minute over. But if anyone's watching this on YouTube replay, I'd also love to hear in the comments, like, what are you seeing in the market that is incredibly valuable, incredibly useful. Love hearing what agents are seeing with their own clients. So just really quickly, how are the new administration policies affecting real estate? I've touched on a lot of this. It's too soon to tell the full impact because we still don't know. Conflicts that could grow greater. Not sure exactly what's going to happen with that. Tariffs, we haven't seen the full impact of tariffs or even what these tariffs will be. But as we've talked about, so surge of inventory, new listings, yeah, we're seeing higher listing and inventory levels. But if it's the administration policies that were causing that, the data doesn't support that, because we're seeing administration policies as far as specific to federal workers in DC, because we're seeing listing levels rise throughout the mid-Atlantic, rise throughout the country. And so it could be overall administration policies, but it seems to be a negligible impact of what's happening with federal workers. And a lot of that's tied up in the courts. But then also new listings were even for the 2024 levels in May. And they're at the low end of what we've seen for the past 3 years. And we saw active listings going up for the last, I think it's 16 months. So it predates this administration. So a lot of this stuff was in motion already. And I think it's tied to factors outside of just, what is happening to federal government employees here. A lot of volatility. We already talked about that. Buyers got spooked in April, seem to have settled a bit in May. And then economy tariffs, like who knows what's going to happen? Like nobody knows. The Federal Reserve doesn't know. They're just in wait and see. An economic slowdown by itself would benefit the real estate market in DC. More than half of all jobs here are recession proof. If we just had an economic slowdown, that should correspond to a decrease in mortgage rates. That would help the real estate market. The problem is we're going to see an economic slowdown with an increase in inflation. That would be stagflation. That's what we don't want, because then it's, what is the Federal Reserve going to do? How are the markets going to react? And that won't necessarily be a good thing. So 3 takeaways. These aren't too different from where they have been, because we're kind of in a similar place, but it's just more important than ever. If you are an agent, stay up to date on what is happening in the market to give your clients the best advice. And if you're a consumer, make sure you're talking to someone who understands what is happening in the market, because things are changing and your perception might be changing, but those two might not be at the same level. So it's very important to be making decisions based upon the actual market. And still a smart time to buy. Like we talked about, 24 straight months of median price appreciation. If you're thinking about buying 2 years ago and thought, I'll wait until mortgage rates come down, mortgage rates are still at the same place, roughly where they've been, but prices are just a lot higher in a lot of areas. Outside of sections of DC, mostly you can always refinance at a later rate, and the sellers still have the advantage. I beat that one to death, so not going to touch on it any longer. If you would like to get a copy of this deck, happy to share it with anybody. Send me an email. I'll get you on the distribution list. If you find this content enjoyable, then you can subscribe on the YouTube channel. You'll get a notification every time I go live. Feel free to like and all that stuff to support all of the work that goes into this. But I love it because I think this is really invaluable. Love having all you join us and the people who end up watching later. So thank you for your engagement and participation. Thank you, Timmy the Great, all smiles, for your wonderful work. I was going to say on the 1s and 2s. I feel like kind of it's like DJ running things. But thank you so much for moderating. Any closing thoughts?
No, I love these. I think it's just so incredibly helpful to see the facts, so we can better explain it to our clients, because there's so much happening in the news, and And it's just really helpful to be able to know what is actually really happening in our local market, like factually, not what we feel, not what we think based off of like one or two clients, but like what is actually happening in our current market. So this is really valuable.
Yeah, absolutely. Very true. And thank you, Tammy. Just want, before we pop off, Maggie talked about in the Virginia market, seeing well-priced, well-presented homes are still moving. Buyers definitely more rate sensitive and cautious. And yeah, that's what I'm seeing too. It's like, it's stuff that's wonderful, turnkey, ready to go, is moving more quickly. And that's also, it's like, as listing agents, that's our job. It's the margin for error is a little slimmer, even if it's still a seller's market in most places. The margin of error might be a little bit slimmer, and homes that are better positioned, homes that make buyers feel more like home, are always going to sell more quickly than those that do not. So thank you all again. Thanks, Maggie. Thank you, Temi. Until next month. See you all later.